Hello, everyone. This is Rich Lowrie, and this is the first quarter. Uh, this is a first quarter update for risk managed equities. We're trying something a little bit new this time in that I'm sending out a recording to everybody, and that hopefully is going to be better than the old way of doing it, which was me setting up 100 Zooms over 6 weeks or so, giving the same update over and over. This way, everybody gets the video at the same time. Everybody gets the same update. We still have a link to my calendar in the email, and I invite you to click that and still sign up for a one-on-one. But this way, we can do the update through video and spend the majority of that time discussing any questions you have or anything that relates to your own particular situation. I'm going to do this in two parts. Part one is just going to be the simple summary. If that's all you're looking for is more of a bottom line, then maybe that'll be sufficient. Anybody that wants to stick around after, I have a series of slides to go through. Of course, I have a bunch of slides to go through, but I wanted to do this in a way where there's both a short version and a lengthier version. Let's get into okay, here's the first slide. This is going to cover risk managed equities. Here is a note from our sponsor. And this gets into the bottom line summary. So here is our current positioning. The main thing over here is the allocation is primarily treasuries and cash. So in other words, we're saying we're really not looking to take risk at this point. The 9% in currency is really gold. So we're in cash, treasury bills, and gold. Safe havens. This is still very much about protecting capital, not taking any risk. It's too early to buy bonds, although we could be coming up on that. Certainly too early to be buying equities. And if anything, this could end up being negative exposure as we get into the teeth of the recession. Just to connect this update with past themes that we've talked about already. We've been saying for quite a while the Fed is going to tighten until something breaks. With the current banking crisis that may be underway, their higher for longer stance means the higher they take rates and the longer they hold them there increases the odds of a hard landing. We think that's the base case, is a hard landing. We're not buying the soft landing narrative. When we do get a Fed pivot, there's still a lot of investors that are anchoring on a Fed pivot as if, hey, everything is going to be okay because the Fed is soon going to pivot. We don't think the Fed pivot is going to be bullish. In fact, it wasn't in 2000. They kept cutting and cutting and cutting, and it didn't matter. Same thing in 2008. We've said that this is going to be in two parts. Phase one is the liquidity cycle downturn. That's going to be followed by the credit cycle downturn. And the credit cycle downturn is underway given the current banking crisis. Markets have never bottomed before a recession. Just because it never has happened doesn't mean it can't happen. But if you're trying to play for the odds say the market is going to bottom during the recession and not before. The recession is still out there, and the name of the game is to let that play out. The real opportunity is on the other side. That's after we go through the recession, after we get another leg down in the market. There should be a setup where the economic data goes from being bad to less bad, which is a positive inflection. And if that is coupled with market signals that say markets are no longer worried about the recession, that's going to be the time to pivot. In the meantime, it's about protecting as much capital as we can so that when that ultimate pivot happens, we'll be able to redeploy more capital. Lastly, T-bills pay 4%, so we're getting paid fairly nicely to be patient, and the name of the game is to continue to be patient. The current themes are very similar, primarily an extension of the past themes. So number one is to stay the course. We want to wait for clean signals of Quad 4. With some of you in the past, I've shared a system of green checks and red X's that we refer to as the market signals. Right now, we're not getting pretty much clean Quad 4 signals just yet. January looked like a transitory Quad 1. You had China reopening, which was generating a positive growth impulse. At the same time, inflation was coming down, and you had some Quad 1 flavor in January. Last quarter, we said we expected the market to bounce, but we didn't anticipate positioning for it simply because the ultimate destination of this is going to be a recession. And we didn't feel that that would be a favorable risk reward scenario. Once we get clean signals of Quad 4, we're likely to be looking to add longer duration treasuries. And that's on the basis that in a recession, inflation does collapse. In a recession, interest rates come down. And a way to play that would be adding longer duration treasuries where we lock in what eventually is going to look like a relatively high yield as rates come down. And we would expect to get paid a capital gain on top of that. The debt ceiling dynamics, we have a different view than the media narrative. The media narrative is making the debt ceiling sound like there's a lot of risk going into the event, and then there's going to be some relief rally on the other side, assuming that the debt ceiling is raised. What we're actually seeing is that the maneuvering ahead of the negotiation is adding liquidity to the system, which is giving the effect of quantitative easing. So net liquidity has three dynamics to it. It's the change in the Fed's balance sheet minus the change in the Fed's reverse repo facility minus the change in the Treasury's bank account at the Fed. And because the Treasury has been up against the debt ceiling limit, they've been issuing T-bills instead of, say, 10-year Treasuries, and that's pulling money out of the reverse repo facility, which is an addition to liquidity. Meanwhile, they're spending their bank account down. They can't ask Congress for an increase in the debt ceiling if it looks like they have a big fat bank account. So as the Treasury's bank account is coming down, as the Fed's reverse repo facility is coming down, that is providing more than enough liquidity to offset the Fed's quantitative tightening. That's added to the positive tone first couple of months of the year. But once the debt ceiling is lifted, then net liquidity, all three levers of net liquidity are expected to go negative. So not only do we have this recession out there, where beginning of the year, I would have said October was the time frame for the recession. If anything, the banking crisis is tightening credit further. That may be pulling forward the recession. And you have this negative inflection in net liquidity once the debt ceiling is resolved, that at this point looks like maybe a June timeframe. Credit cycle downturn is underway. The liquidity cycle downturn is going to re-engage after the debt ceiling. And eventually, the Fed is going to pause. Eventually, the Fed is going to cut rates, but it's going to be too late. So that was the summary version. If you want to stick around for some additional slides, I'll get into those next. This is a very similar summary to what we just covered. I won't spend a lot of time on this. Just to give you a rundown of the banking crisis, small banks are indeed a big portion of the economy. 40% of loans and leases. Small banks are more concentrated in loans and leases as a percent of total assets. Deposits are drawing down. That's what's causing the liquidity crunch. So banks aren't alone in that anybody who owned bonds last year, bonds went down a lot. It was a historic decline in bonds. By some measures, the worst in 100 years, 200 years, almost 300 years, depending on who you talk to on that. Their bonds are underwater just like everybody else's bonds. There's special accounting involved with banks where they don't have to realize those losses, so it hasn't hurt earnings yet. But if deposits start flowing out of banks and banks face a liquidity problem, this isn't a credit problem like 2008. This is just plain, liquidity. If they have to sell those bonds in order to meet deposit outflows, that is currently the problem, where those losses then have to be realized, which is going to hurt their earnings and it's going to hurt their capital position. One estimate is that the tightening that banks are doing, they have been doing this all year for the last year. They have been losing deposits all year, and they have been tightening credit all year, but the current crisis is going to accelerate that. Cantor Fitzgerald estimated that the bank tightening in credit as a result of the current crisis is the equivalent of a 50 basis point increase. The main takeaway is that, at least for our clients, there isn't, the same risks that the people are worried about with the banks. Both TD and Schwab hold your assets in separate custody. This is totally unlike banks, where if you deposit money in a bank, they loan it out before you walk out of the bank, and that puts it at risk. It becomes a liability of the bank, and that's why FDIC insurance is out there. And the issue this time is that now the bailout isn't stock and bond holders, thank God, which is what the problem was in 2008. Now the government's in the business of bailing out uninsured deposits, which are deposits that are over 250,000. So in the recent case of Silicon Valley Bank, the publicly traded $8 billion company Roku, the streaming service, had $487 million bank account. And the current bailout basically made sure that Roku's 487 million was protected. And that's still an open question about whether that practice is going to continue. It's not clear at this point. Here's a chart. I apologize if it's a little blurry, but this shows money market yields and the Fed's target rate. And this shows what banks are paying on savings accounts and checking accounts. This huge spread is a big factor driving deposits out of banks, where they're saying goodbye to these rates and they're saying hello to these rates. This isn't anything new. This has been going on for pretty much all of the last year. And recent, the recent crisis is just accelerating this faster. In terms of where we are in the business cycle, here is a stylized depiction of it. You have your long leading indicators turned down first. That's followed by shorter leading indicators that go down next. And then eventually the slowdown catches up with coincident indicators and they follow. This is about as close as I could depict it to where I think things currently are. Long leading indicators have been going down. They peaked in 2021. Shorter leading indicators recently went negative, and it's a matter of time before this gets pulled down, to the zero line, with coincident indicators basically being what defines a recession. So we're not there yet, but the direction of travel is there, and the destination is going to be down here. At any given point in time, we're tracking a bull case, a bear case, and our base case. This really hasn't changed from last time. Our base case is that by looking at lagging indicators like the labor markets, the Fed is going to over tighten and things are going to break. That's happening. Second half recession is still in the cards. The credit cycle downturn is now underway, and that may pull the recession from October, which is my best guess, beginning of the year. And it's possible that that could happen sooner. And then net liquidity, as I mentioned, is going to inflect back negative after the June timeframe. If you look at recession indicators, the nominal employee compensation cycle is saying that we could see a first half recession. Jobless claim cycle, yield curve inversion, the ratio of leading to coincident indicators are pointing to either first half or second half. I'm going to give you an example of two of them and show you the data behind it. But the thing I want you to keep in mind is that the Fed's own forecast for PCE inflation and unemployment are implicitly calling for a recession. So anybody who is hoping for a Fed pivot to bail out the stock market needs to realize that the Fed is forecasting a recession. I don't think they would ever go on record in a press conference and say, yes, we need a recession. But their own forecasts are consistent with the recession, which means when it comes, I don't think they're going to be surprised by it. In fact, I think that they think they need a recession in order to bring inflation down to where their target is. Here's nominal employee compensation. When the lines cross, the blue and the black line cross, you put a dotted line here. And then you go back and say every other time you had a dotted line, it happened during a recession here, during a recession here, just before the recession, a little bit before the recession, a little bit before, during. So this has a good track record of coinciding with recession. The only problem with this as an indicator is it often is late. It often triggers when you're already in a recession. There have been a few exceptions here. This could be one of the exceptions, but this is an indicator that's saying that the recession is near. The other one, which is a ratio of leading indicators to lagging indicators, is quite negative. Current reading is way down here. And what that means is leading indicators have collapsed, but that collapse hasn't yet translated into the coincident indicators. So if you look at this negative spread today and draw a line and say any other time that this spread has gotten this negative, what happened? So recession here, recession here, recession here, here, and this was a recession even though it wasn't as negative of a spread. So this is saying it's a matter of time before coincident indicators catch down to where leading indicators are. Whether the market has priced a recession in or not, I think this is a pretty emphatic no. If you look at the ratio of high beta stocks to low beta, its current reading is 1.6. Prior recessions, this was the lightest recession in the last 100 years, at the tech bubble and the financial crisis. Bottomed at 1.7, the mean is 0.9, and we're currently at 1.6. That implies a lot of downside. Financial conditions have tightened a little bit in the last month, but are nowhere near as tight where they normally get in a recession. That's saying quite a bit of downside. Earnings yield is quite low relative to levels that it typically reaches in a recession. And to get the earnings yield to go up, prices have to go down faster than earnings go down. This is saying a lot of downside. And high yield credit spreads are fairly tame. They're about 5 percentage points above similar maturity treasuries. And look how wide they normally get in past recessions. So recession is not priced in. If you want to look at hard landing versus soft landing, 2012 and 2015 had soft landings. None of the conditions on this page were met. So by definition, that is a soft landing. The financial crisis, every variable on the page triggered. The tech bubble had all but two trigger. And the current situation is that all but two are triggering. Now, financial conditions are expected to continue tightening given the banking crisis. I think it's a matter of time before this turns into meeting the criteria. Corporate balance sheets are relatively healthy. And this is likely to be the last shoe to drop. But the point here is, we're past the point where soft landing is a viable outcome, in our opinion. Despite that, every past recession has been associated with talk of a soft landing until the real recession gets here. This comes from a piece that Piper Sandler did, where they went back to every major recession and found that soft landing is all everybody talked about until the actual recession arrived. So I would ignore what the media says about soft landing. In terms of how much worse could it get, the first two are kind of the bull scenarios, which require a soft landing. And that assumes that earnings are going to hold up, and that assumes that cash flow is going to hold up. Otherwise, we're looking at a hard landing, where a more realistic measure would be the so-called Buffett indicator, which says there could be 25% more downside, or a simple median price to sales, which says down 30. Despite that, I wonder whether median multiples are even worth looking at. And the big reason why is that there is an alternative to equities, namely T-bills yielding 4%. So if you have an attractive alternative, at some point, I think more people are going to seek that out, which means prices could ultimately fall lower than what these median valuations would suggest. Here is the Fed's so-called dot plot. So the technical name for this is the Summary of Economic Projections. This comes out quarterly by the Federal Reserve, and it's a composite of what the 12 voting members of the Federal Open Market Committee estimate with respect to growth and unemployment, inflation, et cetera. The part I have circled is what I want to focus on. The unemployment rate by the end of 2023, they say it's going to go to 4.5%. It ended 2022 at 3.7%. The problem with that forecast is if you go back historically and say, let me look at every other time unemployment increased 80 basis points in 9 months, it's never happened outside of a recession. I believe that the Fed knows this. And this is part of their implicit recession forecast, which means, again, once the recession gets here, they're not going to panic and they're not going to turn the printing press back on. They're probably going to say, oh, good, things are happening in line with our expectations, and we need a recession in order to get inflation to come down. Also notice that since the last report in December, the unemployment rate, they forecasted down slightly, which to them means labor markets are resilient, which means the economy is stronger, which means higher for longer, and they're going to keep rates high until things break. Here is the data behind it. When the blue bar goes up to touch the red dotted line, look what happens. Recession, 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 here, 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 and here. Pretty good batting average. And the Fed is basically saying they need the blue bar to reach the red bar. And I don't see how that happens without a recession. As far as inflation, PCE inflation, which is basically same thing as CPI, only the Fed likes this better because the basket is weighted to essentially match the composition of GDP. Ended the year at 5.7%. They think it's going to go down to 3.3 by the end of this year. And the problem with that is PCE inflation has never declined 240 basis points in 9 months without a recession. So same thing. They are forecasting recession. They are not going to panic and turn the printing machine on once it gets here. Also notice, since the last report in December, their forecast for inflation actually ticked up. So to the Fed, the labor market has gotten a bit stronger, inflation has gotten a bit stickier, and that's consistent with their higher for longer, hike until they break things approach. If you look at the setup, economic regime is the economic data that we track. Highest probability on a 3-month basis is quad 4. Highest probability on a 6-month basis is quad 4. Here was the transitory reflation that current market environment had been characterized. This is our report coming into the beginning of the month, so it didn't capture the banking crisis. The numbers as of this morning had both quad 1 and quad 2 down considerably, and now it's quad 3 and 4 vying for the lead. So if we do get a clean quad 4 picture that does align with the market, the bottom-up economic data, that's going to represent a clean signal to us, and that is going to prompt us to add treasuries and do some other possible positioning. Got interrupted by my dog again. I'm sorry. This goes back to the patience. This is the tech bubble. Notice all of the double-digit bounces: 19%, 31%, 17%, 14%. They happened with regularity. And I would not count out at all that we can't get another one, or that we can't get 2 or 3 of them. And our goal is going to be to resist the temptation to chase these, because until the recession fully plays out, it's a very risky proposition to try to position for any of them. A point on bonds. If you think of bonds, they typically are a stabilizer in a 60-40 portfolio. However, this is a look going way back to the 1870s at the correlation between stocks and bonds, and the main conclusion is down here. When inflation is 2% or low, stocks and bonds have a negative correlation, which means if you have bonds in your portfolio, such as a 60-40 portfolio, they indeed can be a stabilizer, meaning when stocks go down, bonds are going up, and that's taking some of the edge off of it. Last year, everybody learned the hard way that when inflation gets high, that correlation breaks down. Inflation above 5%, stocks and bonds have a fairly high positive correlation, meaning when stocks go down, bonds also go down. But even 3 to 5% inflation, there is a slight positive. And the fact that it is positive means that over the coming year, 2 years, 3 years, 5 years, 10 years, it would not be unexpected at all to have bonds lose that negative correlation simply because inflation remains sticky. So this is kind of a call to say that we should be reevaluating both the role and the sizing of bonds in a portfolio, because we've come off a 40-year period where all interest rates did was fall. All inflation really did was fall. And as long as those were the underlying conditions, it reinforced that negative stock and bond correlation. And if that's over and we're entering into a period where inflation is going to be above that level, then that calls for reevaluating the size and the role of bonds. So key takeaways: things are starting to break. The liquidity cycle downturn is ongoing, but now it is blending together with phase two, which is the credit cycle downturn. The banking crisis is catalyzing that. And what that has the effect of doing is further tightening credit. And that's likely to pull forward the October timeframe for a recession. The Fed is forecasting recession, so it won't panic. Recession is not priced in, so I still think the worst lies ahead. The more things break, that will get them to pivot, but I don't see that as being bullish. I certainly wouldn't want to be invested into that. I have a couple of charts to share before we wrap it up. But in the 2000 tech bubble, the Fed cut rates 12 times, and it didn't matter. The first couple did produce a bounce. It did generate hope that, hey, now the Fed's cutting, the Fed has this. But by the time they got to the second, third, fourth, fifth, sixth, the narrative shift was that, oh crap, even the Fed sees a recession is here, and markets continue to go down. So patience is the key. We're getting paid 4% to ride it out in treasuries. The goal is going to be to preserve capital until we get through this. When we get the proper signs that the worst is behind us, I think we should have a pretty attractive pivot on the other side. But again, the goal is to be patient and allow that to play out. Here's a picture where you had a Fed pivot followed by the worst part of the downturn. A Fed pivot, worst part of the downturn. That was in the 70s. The Fed pivoted here and the worst was ahead. Fed pivoted here, the worst was ahead, worst was ahead. And the question is, once the Fed eventually pivots, is that really going to save things, or is that going to be similar here? Market participants eventually come around to thinking, oh crap, even the Fed sees a recession is here. This is the rate hike tightening cycle. They tightened into a slowdown. Here's the pause, and here's when they cut. They cut all through the tech bubble crash. They hiked. Here was a pause, and they cut all the way through the financial crisis. And we are probably at the point, I would think that this last rate hike is probably the last. So let's say they pause from here. The pause is going to last long enough until the recession hits. Then the Fed is going to begin cutting. And, I really don't think that that's going to be anything or anywhere near enough, to get things turned around. So appreciate you tuning in. If you want to click the link and do a one-on-one, feel free. Look forward to talking with everybody. And with that, appreciate the trust and confidence that you place in Park Edge. Thank you.